They're beginning to turn to gold for good reasons, namely that the economic narrative is changing to a narrative that is positive for gold. You know, when you have a weaker economy, cuts in interest rates, inflation that is stubborn and slowly moving up, and a dollar that is falling, that is the ideal environment to be buying gold. So I think slowly over time, and then suddenly we're going to start to see more retail, if we want to use the word retail in broad terms, retail interest in gold.
Even an official bear market in gold would actually leave us at a level that would be extremely bullish for the real world business of gold mining, and similarly in silver. But, you know, $600, even $1,000 down from where we are now would still be a profitable level for all but the crappiest gold companies out there.
Gold prices have surged by over 50% in the past few months, surpassing other asset classes, such as equities and real estate. The yellow metal is trading near its all-time high levels, and experts believe the bull run might continue with periodic corrections. Chinese non-official buyers and wealthy families in the Middle East and Asia have been accumulating physical gold as a form of insurance against fiscal risks and potential dollar weaponization. According to AdrianDay, this is why physical gold has outperformed mining stocks in the current cycle. In short, the biggest players are building a fortress of physical insurance against paper risks and geopolitical chaos. This is a vote of no confidence in the fiat system, and it is the real engine behind gold's surge. At the same time, they estimate that China's true monthly average central bank purchases since late 2022, excluding the 6-month break in 2024, have been around 33 tons. The IMF data, by comparison, shows an average of 10.7 tons per month over the last 3 years. Even if China's central bank is buying more gold than it reports, the analysts said it would take nearly a decade for reserves to grow to 20%. Concurrently, Adrian notes that central banks have cut dollar reserves from 75% to below 50%, shifting heavily into gold. With ongoing fiscal and geopolitical risks, he expects this trend to continue, alongside wealthy individuals buying gold to hedge debt and monetary concerns. In his outlook, Adrian emphasizes that retail demand is beginning to act as an afterburner for gold, with $3.3 billion flowing into GLD last month and tentative inflows into GDX and GDXJ. While ETFs saw steady outflows earlier this year, he views the recent reversal as a sign of shifting sentiment, reinforced by rate cuts, stubborn inflation, and a declining dollar. Before we dive into AdrianDay and Lobo Tigre's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I mean, we all know that gold moved up dramatically before the gold stock started to move. So this was let's say, a different kind of bull market that we had. And I think we all know the reasons. The people, the institutions that were buying gold, were buying gold assets, were buying largely for defensive reasons, for insurance reasons, whether it was the central banks, whether it was Chinese non-official buyers, whether it was wealthy families in the Middle East particularly, but also in Asia. They were buying for various reasons, but all of those reasons came down to defensive reasons. And so if that's your motive, you buy physical gold, you don't buy gold stocks. Now, we have to ask ourselves, is that buying likely to continue? When you look at the central banks, dollar assets are now down to about, the last number I saw from the ECB was, European Central Bank, was 47.5% of foreign central bank foreign reserves were in the dollar. That's down meaningfully from about 65% 5 years ago and about 75% at the beginning of the century. So it's down significantly. But here's the reason. Here's the thing. If you're selling the dollar and with a lot of those proceeds you're buying gold, if you're selling the dollar because you want to diversify your assets in the face of a fiscal problem in the US and in the face of dollar weaponization, that hasn't changed. Those motives have not changed. And so I would say if 47, let's say 50%, if 50% of your assets are in the dollar, and those are your motives, is that still too high a percentage? And I would argue that for many, many of the world central banks, that is still too high a percentage. So I think the selling of the dollar and therefore the buying of gold from central banks is just going to continue for quite a while. When we talk about wealthy people and others concerned about fiscal issues, there's no indication that the fiscal issues are going to change. For the better, I should say, for the better. And so the reasons for buying gold for those people are just continuing. So in short, what I'm saying is that all the reasons people have been buying gold for the last 3 years still exist. And so I would expect us to continue to see gold buying. People have been buying physical gold, but not, as this shows, not in any kind of dramatic rush. But just in the last month, we've had $3.3 billion of inflows into the GLD, which is really quite significant. It's not quite showing there, but I looked at the latest numbers just before we started this interview. So I think we've seen a turn, and we've also seen a bit of a turn, not consistent, but a bit of a turn in the flows into GDX and GDXJ. And that is a clear signal, a clear reflection of retail or, individual investors, if you like. They will go for GDX, GDXJ before they start picking individual stocks. And as I say, it's been a bit of a turn. The last month still has net outflows from GDX, which, just think about it. Look at where the gold price is. Look at what the gold stocks are doing. Look at the margins that they have. There's no other sector in the US with margins as strong and with growth in margins as strong as the gold stocks. And yet in the last month, we've had 330 million of outflows from the GDX, which, to me is mind-blowing, frankly. But it's been a bit of a turn. You look at the year to date up until, let's say, the third week of August, and you had something like 3.5 billion flow out of the GDX. And we've seen that slowly change, and it was consistent. It was almost week in and week out. There was hardly a week this year that had net inflows. That's changed in the last month. So my conclusion from that is that retail, if you want to use the word retail, but also just non-gold specialists, non-professional managers are beginning to turn to gold. And they're beginning to turn to gold for good reasons, namely that the economic narrative is changing to a narrative that is positive for gold. When you have a weaker economy, cuts in interest rates, inflation that is stubborn and slowly moving up, and a dollar that is falling, that is the ideal environment to be buying gold. And the narrative for the last 3 years was quite the opposite. The narrative was a strong economy, high interest rates that Powell didn't want to cut, an inflation rate that had come down sharply from COVID days. So the narrative was of an economic environment that was not conducive to gold. I didn't agree with the narrative, but that was the narrative. And now it's definitely shifting in favor of gold. So I think slowly, over time, and then suddenly we're going to start to see more retail, if we want to use the word retail in broad terms, retail interest in gold. But I prefer to think of it as non-specialist interest, which includes retail, but also includes, family offices. It includes mutual funds, frankly, that are not gold funds. It includes any kind of generalist, where we're beginning to see more interest from that sector.
In the interview, Lobo Tiggre explains that once a market turns parabolic, fundamentals like valuations lose relevance. While acknowledging risks of sharp pullbacks at major milestones, he says his instinct is that gold is pushing toward $4,000 and silver toward $50, levels that could spark heightened volatility. Investors are concerned due to geopolitical uncertainty. The precious metals rally has coincided with the Trump administration's drive to remake global trade. Most of Trump's trade policies have been unpredictable and fast-moving, Looking longer term, Tiggre notes that central bank gold buying has become a paradigm shift, particularly for nations like China and Russia, which seek to reduce their dependence on the US dollar. He argues this structural demand places a firm floor under the gold market, meaning that even after a major pullback, the bull market is unlikely to end. In his view, a sell-off would be a dip rather than a collapse, with strong central bank demand ensuring long-term support for both gold and silver. Let's get back to the interview.
When something goes parabolic, that the odds of that correction that we talked about, they go up with that parabola. But when something is going parabolic, it makes no sense to talk about valuations or reasonable earnings projections or NPVs. None of that matters anymore. Just because something's overbought doesn't mean it can't go overbought. So you can't just say, oh, it's gone up, it's too expensive, therefore it must go down. On the other paw, you can't say it's got to keep going forever. And okay, Lobo, you're not helping us very much. It may go up, it may not. So what? Well, would you rather have me say, oh, it's going to the moon and convince you it's going to the moon and then have you lose a bunch of money tomorrow because it goes to hell instead? So please, dear audience, don't get mad at me for trying to be honest with you and tell you how I see the odds. So with that caveat in place, for whatever it's worth, my gut, my wolf whiskers, as it were, I think gold just wants to take out 4,000. It's one of those round numbers that it may be irrational, it may not make any sense whatsoever. It doesn't matter to the producer if gold is 3,999 or 4,001, but it sure seems to matter to Mr. Market. And when he's got the bit in his teeth and he wants to run, he just seems to go there. And then that's when you start worrying about the bigger correction when that round number gets hit. So I'm not making any predictions. I'm not making any promises, but I'm answering the question. My feeling, for whatever that's worth, is that it wants to take out 4,000. Silver wants to take out 50. The last time I felt this way was when gold seemed to want to take out 3,000. And that was right. So if that's worth anything, I always put the caveat, the time before this, it was a long time before I felt this way, was in 2011 when gold hit 1911 intraday high. I thought it wanted to take out 2,000 and keep going. And boy, was that wrong. So I'm not trying to tell you I'm always right. I'm not trying to tell you I know the future. I'm answering the question. My gut sense is that it wants to go higher. And then once we hit those round numbers, buyer beware. And don't forget that nobody goes broke taking profit. The famous, infamous last words are, this time is different. But when people snidely say, oh, this time is different, snark, snark. What they mean is human nature doesn't change. So if you're going to say, oh, governments won't try to print their way out of this, they won't inflate away their debts or things like that. That's the kind of this time is different thing that I would call bullshit on. Of course, they're going to do that. That's what they always do. But of course, things do change. We've descended from the trees a little while ago, right? The Industrial Revolution happened, right? So the horse is no longer the main means of transportation, right? So things do change. It's not like nothing is ever different, obviously. And I bring this up because I think the central bank gold buying it's a one-way door. There's no way the Chinese or the Russians or their friends are going to say, oh, you know what? We're perfectly happy having Washington and New York control our financial lifeblood. It's a paradigm shift. That's a one-way transition. And okay, maybe there's some theoretical limit to how much gold central banks might buy, but that is so far and away above and beyond where we're at now. Their capacity to buy, their capacity to print and buy is actually theoretically unlimited. Mm-hmm. So this is a big deal, right? And normally, it had things been the way they were before, like had this not happened, then I would be much more worried now. I might wait for 4,000. I might not just take profits. I might just be selling because I've already made a bunch of money, right? But with that game changer, really is, I do think it puts a floor under. And we've seen things that would normally be a big headwind for gold, right? Ironically, higher inflation, because that means the Fed's going to raise rates and gold doesn't pay interest, right? Or other news that would in previous years have knocked gold back. Ever since 2022, it doesn't. Maybe there's a little dip and somebody's buying. Somebody with deep pockets is buying, cue central banks. So this is a long-winded way of saying how to play the dip is that I do actually think it would be a dip. I do not think that if we hit one of these numbers and it triggers a bunch of selling and then that cascades, right? People get stopped and it just cascades lower. I don't think that's the end of this bull market. I don't think we're looking at 2011 to 2015 for gold and silver. I think it would be a dip. Where and when to buy, I don't know. I have a feeling that it would be pretty sharp. you go up to such a big degree, you have such a sharp hockey stick. Anything goes parabolic, the downside and the other side is pretty sharp. So it might exceed the typical 10%, correction, or 20% for a bear market. We could see a technical bear market trigger, but 20% down from where we're at now, that's only $600. That takes us back to $3,000 gold. Like the actual business of mining this stuff and discovering and developing projects, $3,000 gold is a fantastic level. You make all kinds of money at that level. So even a bear market in gold, hear what I'm saying, even an official bear market in gold would actually leave us at a level that would be extremely bullish for the real world business of gold mining, and similarly in silver. But $600, even $1,000 down from where we are now would still be a profitable level for all but the crappiest gold companies out there.
Since gold is the ultimate safe haven, it should still form the bulk of your precious metals allocation. Silver is a riskier hedge. If stock markets decline and economic activity decreases, silver is likely to underperform gold. Are we simply witnessing another cyclical rally, or the unfolding of a lasting monetary realignment away from the dollar and toward hard assets, such as gold and silver? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.